next we have is Joshua um, from the USA. And Joshua, very warm welcome. And tell us what's been happening in the USA in terms of blockchain adoption, tokenization. What are the kind of key updates? And I know there are a lot of updates, but what does the world, what can we learn from the US, who is quite leading in this space at the moment? Thank you.
Thanks. Thank you so much. Can you hear me okay?
Yes, yes, perfect.
Okay. And how many minutes do I have? I'm sorry, I wasn't able to
Sorry,
hear you.
about 10 to 12 minutes. Yeah.
Okay, perfect. Okay, well, thank you, everyone. Although I'm calling in about the US, I'm actually sitting right now in Brussels, believe it or not. So it's a pleasure to be here. So much has changed since the last time that I was here on behalf of the US. Basically, everything has changed, pretty much a 180. So where previously you may have heard me say, enter at your own risk, be very cautious, everything like that with respect to digital assets in the US. Now, perhaps for the first time since the beginning of the digital asset space, the US is really open for business. And what do I mean by that? I mean that the era of enforcement is over for the federal regulators, at least for now. If you are not committing fraud, committing crimes with criminal intent, I think enforcement is not the emphasis for the federal regulators. So for example, the SEC, the CFTC, others. I think what we saw before in the prior administration was a lot of interagency competition and sometimes interagency infighting, right? And what we've seen now is a new shift towards collaboration, right? If we look at some of the same statements that are made, for example, by SEC commissioners, both the last time I was here speaking and now, the last time we had Gary Gensler saying we don't need new laws because we have all the tools we need, essentially, to regulate crypto. And what he meant was enforce it out of existence, it seemed, right? And now we have Chair Paul Atkins at the SEC saying we have the tools that we need. Even in the absence right now of a market structure bill, we can regulate crypto and we can do it in a way that welcomes digital assets and that does not make everything a no-go. So I think this is a critical distinction. I think we are still waiting at the federal level. And for those who are not familiar with this, I will back up even slightly further to say, as I believe most people know, we have a federal layer of law and then we have 50 states. So right now I'm speaking about the federal level. And as you also likely know, we have many regulators who over time have claimed jurisdiction over digital assets, whether it's the IRS treating it as property, FinCEN treating it essentially as money, the SEC saying when are there securities involved, the CFTC saying when are there commodities involved. Now, what we have as well right now as a backdrop, we have very crypto-friendly regulators, right, all marching to the drum set by the administration. And as I think people know, the president gets to appoint the heads of these federal agencies, and then they are confirmed, by Congress, right? So this is an important thing. President Trump has sent a message, even from the campaign trail, that he was going to make the U.S. the crypto capital of the planet, is what he said. And he really has taken actions to put crypto on par in many ways with AI, which the US previously, even under the prior presidential administration, had recognized as a race to the moon, a talent war, an arms race, right? And now crypto is on parity because we have the first ever AI and crypto czar. We also have, in addition to Paul Atkins, we are very, very fortunate to have as acting CFTC chair, Caroline Pham, who spoke at a prior British Blockchain Association event at Parliament recently. And we're extremely fortunate to have her, not only because of her collaboration with Paul Atkins and Hester Peirce and others, but because Caroline Pham, even under the Biden administration, put forth a digital assets subcommittee of the CFTC's GMAC. And she has been very forward-thinking. So there's a lot of cross-agency collaboration. There is something called the crypto sprint that has been going on at the CFTC, right? Things that are being explored, including using tokenized collateral, and permitting that. Also at the SEC, Project Crypto, and this whole idea of bringing together the CFTC and the SEC when it comes to digital assets, and saying maybe we will have regulated trading platforms that trade all kinds of different assets, whether they're securities or commodities, right? Digital assets of various kinds, as well as potentially other assets. So it's a very, very exciting time. What I would say from a congressional perspective, just really briefly, is people may be aware that earlier this year, Trump signed into law the Genius Act, which governs stablecoins. Now, importantly, many people don't realize that that law, while it is law, it hasn't taken effect yet. When does it take effect? January of 2027, or 120 days after all of the implementing regulations and rules are put in place. So it is a broad framework, but we need Treasury and other certain other regulators to actually provide rules. And Treasury has put out some proposed rules for comment. So this is, the wheel is turning. The President's Working Group on Digital Assets Markets has put forth recommendations, including that the Genius Act be implemented faithfully, as well as many other things. And agencies are getting ready for this. The banking agencies, for example, the OCC, the Fed, the FDIC, which under the Biden administration had been very restrictive of banks and others engaging in digital assets related activities. That has all been repealed, right? Those letters requiring supervisory non-objection before banks engaged in digital asset activities, these have been rolled back. So we're seeing a much friendlier regime. We also are seeing with the Genius Act, just for those who are unaware, this sets out the requirements to be a permitted payment stablecoin issuer. Why does this matter? Well, a permitted payment stablecoin, right, which is a dollar-backed, although it could involve other currencies in the future, should Treasury implement the rules in that way, and eventually it will. But it's basically a fully backed stablecoin, and it would neither be a security nor a commodity. Now, the SEC has already given some indications of when it thinks a stablecoin would be unlikely to be a security, right? For example, if it doesn't provide yield, if there's no interest on it, things like that. They've given that in guidance. Genius puts that in writing, right? And says, the issuer cannot provide yield to the holder of the stablecoin, cannot share the yield or interest. Now, there is an ability of a third party, right, of a service provider or something like that to provide yield. And many say, well, that's a feature, not a bug. However, the banking lobby in the US has very strongly opposed the ability to do that because many believe that they are concerned about the effect that it will have on tokenized deposits, right, and the way that banks make money. There also is a large push by the bank lobby to really restrict who can become a permitted payment stablecoin issuer, essentially wanting to restrict it to banks. Now, the way the Genius Act does work, though, it provides a federal path and a state path, depending on which way someone wants to go. I won't go into the details of those, but it does treat permitted payment stablecoin issuers as though they are financial institutions, right? They're subject to the BSA, the Bank Secrecy Act, and other requirements. It is a very exciting time that we do have that in place, even though, as I noted, it is not in effect yet. It won't be in effect for a bit. And there is a grandfathering provision that goes with it for stablecoins that are launched in the meantime. But I think it's a very exciting time. And for the US, it also is a bit of a treasury play for those who are following along at home, right? Because in many cases, these stablecoins will be fully backed. Now, also importantly, these reserves will be one-to-one, and they will need to be segregated. And so that holders would actually have a claim, right, against the reserve, as opposed to just a contractual claim, or having to use certain wallets or things like that, which has been sometimes the case with other types of stablecoins to date. Now, quickly flying through market structure, we do not have a market structure bill yet. The Clarity Act was passed through the House. There have been discussion drafts in the Senate. A draft recently was leaked by the Democrats in the Senate. People were quite unhappy in many respects with some of what it said, so it's a bit back to the drawing board. But there is an RFQ out that the deadline has passed for, but where the Senate was looking for feedback as well. Now, you may say, well, what if we don't have a Market Structure Act? How are we going to move forward? And remember, the Market Structure Act is going to divide out, what is a commodity? What is a security? How does this all fit together? Well, if you ask the regulators, they say we don't really need it, right? We can do a lot of this on our own through rulemaking, which is something, other than some proposed rules that were really aimed at, in many people's views, destroying crypto under the prior administration. There's a lot of potential rulemaking that may be done. And some things, the heads of the agencies, including the SEC, believe that they already have jurisdiction and already have the ability to do this, and congressional go ahead. Now, what we have to realize, though, is that there are still laws on the books. If we're not having Congress change the law, we do have the results of cases that were out there, including Ripple, for example, which kind of split the baby and said that certain sales of digital assets were sales of securities and others were not. And other cases like the library case, which said that the library token was a security. Right now, the current SEC may feel very differently about that and probably would not have brought those enforcement actions. Nevertheless, this does stand as law. So we still do see plaintiffs' lawyers suing under these theories. So this is where it is very important that we have some sort of change in law at some point, because we can get guidance from the SEC, but until we have changes in law, we do still have to contend with the case law that exists. So I think I'm at 12 minutes. Maybe I'll pause there.
No, I think that was an excellent summary, Yoshua.
Thank you.
Just one question that we get asked all the time, especially for our global audience and members who are not very familiar with the US laws, is that we hear this like Wyoming blockchain law and other law. So how much autonomy do they have, these like over federal laws, like these states? So can they pass their own laws that are more kind of crypto friendly, or eventually they have to abide by the federal laws? What is, in a very simple, easy to understand way, if you could explain?
So yes, they do have ability to pass laws that are different. Now, sometimes these laws, let me back up slightly. There are instances, for example, under the Genius Act, right, where there are two paths expressly permitted by federal law. So the Genius Act expressly permits a state chartered path. So the Wyoming, and I have my little quote here from the Wyoming Blockchain Symposium. I'll actually be in Wyoming on Friday. They have a special purpose depository institution, right? And having something like that would be a path that would be permitted under federal law that differs from, say, getting an OCC charter. Now, you may say, well, okay, so a state can regulate the way it wants to treat digital assets within its state. When you start branching out to other states, then you start getting into questions of, oh, well, do I need a money transmitter license in this other state, or are they going to accept it? So I think that's one of the things. The state has great latitude within its state, right? Even back in the day, a long time ago, Wyoming took the position that digital assets, generally speaking, were property, right? As opposed to necessarily being securities, which was the stance of the SEC at the time, right? And they said, well, okay, there may be federal preemption or supremacy with respect to securities law, but the states have supremacy with respect to property. So yeah, they have a lot of discretion within their own state. One of the things that was really, some folks tried to get into the Genius Act was this idea that if you had a state chartered entity, that there would be 50 state acceptance, right? And that did not quite make it into the version of the Genius Act. So that still is a path that people have to follow. And I have some clients that are working on that right now, like figuring out what other kinds of licensing you might need, because some states may accept, others may not. And of course, if you start getting into questions of, will the federal government make all these other states accept this one state's or this other state's entity type and license, then it gets into questions of, state banking regulators and others saying, wait, this is the role of the states. You can't just force us. But yeah, it's a very interesting and complicated question. One of the really, I'll say, I keep saying interesting, but an interesting point to me is that a lot of times people say, okay, we need to go the federal path. Not everyone says that, right? There are benefits to each. I'm going to go through it really quickly. And people say, oh, well, it's a smooth glide path if you say get an OCC charter. And that may be the case now, just like it was the case under Brian Brooks, when Brian Brooks was the head of the OCC. But during the Biden administration, not so, right? And we had a very different set of banking regulators and a very different stance, right? Which carved all that back. So the more you push things to Washington, on one hand, great. And certainly for people in other countries, when they're trying to do business with the US, they might say, we'd rather deal with one charter instead of 50 states, right? But then when you look at some of the benefits that a state like Wyoming may have, well, we know, generally speaking, how Wyoming has been coming out and being pro-crypto for many years, and that's very unlikely to change. Whereas at the federal level, things may change more. That being said, I will say, I have been describing it this way. People keep saying, well, with the next administration, couldn't they just outlaw crypto, or couldn't they just turn this all around and, and have everyone shut out again? I mean, anything's possible. However, what I would say is it's a lot easier to prevent seeds from being planted than it is once you have, this whole ecosystem in the US sprouting, growing, going around and ripping up all of these shrubs and trees. That's a lot harder. And I think with the types of businesses and investments that are being made now under the Trump administration, with major players, and traditional financial institutions also getting involved, the wirehouses are now coming online with crypto ETFs and other things. I think it will be harder and harder for someone to come in and put a stop to it, because now so many more people are invested and bought in. And by people, I don't just mean retail, I mean really like the players on Wall Street and beyond.
Yes, indeed. No, that was excellent explanation.
Thank you.
Thank you very much, Joshua. Thanks for joining us.
Thank you for having me.
Thank you.